In this video, I want to highlight 10 steps to master asset allocation for optimum investment returns. When it comes to asset allocation or investing in general, this particular concept is key for you to be able to understand fully the strategy you are going to use to allocate your capital into different asset classes. You may consider classes like cash, real estate, bonds, mutual funds, index funds, hedge funds, commodities, and precious metals, and other related, classes. And it involves, number one, understanding your financial goal. Before you talk about investing in these asset classes, before you talk about, mastering asset allocation, it's very important you first of all understand your financial goal. You need to ask yourself precisely what are your aims and objectives when it comes to investing. Generally, you may be investing, to be able to provide probably a house for yourself, maybe a car. It might be to cater for your children's school fees. Whatever the long-term or the short-term objective may be, let it be very, very clear to you so as to be able to guide you in your investment journey. Number two, assess your risk tolerance. When it comes to investing, investing generally is a risky enterprise, but that should not scare us away. Our own duty is to see how we can mitigate this risk. And the point here is that you ask yourself precisely, what is your risk tolerance? Are you the type that can accommodate higher risk, or the type that can tolerate a lower level of risk? And that could make you, that could classify your risk tolerance into maybe moderate or conservative or aggressive. Whatever is the case, ensure that you fully understand precisely the level of risk you are willing to bear so as to be able to obtain the kind of return you want to achieve at the end of the day. Number four, diversify across asset classes. This is exactly what we are trying to point out in this video. Usually, you have to diversify because of the level of risk involved in investments and the kind of returns you want to achieve. It's necessary you diversify across different asset classes, and these classes could be maybe stocks, it might be real estate, it might be mutual funds or exchange traded funds. It might be even cash. Cash itself is the most liquid asset you can find. So that could equally act, as a means of, asset diversification. So it's very, very important you don't put your egg in one basket so that in case a particular asset class performs poorly, it will not negatively affect your overall returns at the end of the day. Number five rather, consider your current financial situation. It's important you determine precisely your financial situation or condition at the present stage, at the present time. You talk about your level of income, your expenses, as well as your assets, because this will go a long way in governing the kind of strategy you are going to use in your asset mix. If your income daily is if your regular income is not all that huge, and you want to be able to get something to support your lifestyle on a regular basis, then of course your asset class, your asset mix will be such that will be able to produce enough income stream to sustain the kind of lifestyle you want to undertake. So you must first of all determine your current financial situation and the flow of income, the kind of money you will need to be able to sustain the lifestyle you want to actually sustain. Number six, regularly rebalance your portfolio. It's important you review your portfolio on a regular basis. You don't just buy or allocate your resources into these different asset classes and then take and take your leave. No, regularly you are expected to review. Whichever asset class is not doing very well, it's advisable you sell that particular asset, and reinvest the fund into the ones that are doing very well. And by so doing, you'll be able to meet up with the investment objectives, and you'll be able to obtain the the what you have in mind to be able to obtain from your investment in the long run. So it's necessary that you rebalance your portfolio. We cannot do without rebalancing our portfolio across these asset classes. Number 7, incorporate tax efficiency. When it comes to investing, tax is something we cannot run away from. And it's something we should be very, very careful to handle, tax efficiency in investing. That's why it's encouraged that we invest in tax efficient vehicles like the IRAs, like the 401k plans, and other classes that do not really require you paying an outsized level of tax. And so tax consideration should be incorporated into your asset mix. Please subscribe to this channel and press the notification button so that when I bring a video of this nature, you'll be among the first people to benefit from it. Number 8, factor in economics and market condition. When it comes to investing, whether we like it or not, externalities like the market condition, like the performance of the economy will invariably impact our investment. And that's why, conditions like inflation, like unemployment, like a rise in interest rate, all these factors, have its influence, one way or the other, in the magnitude of our investment return. So we must consider all these economic indicators. Number 9, use low-cost investment vehicles. Some vehicles actually, investment vehicles are known to be low cost. They don't really cost you much. They don't really charge much as fees. A very good example is like the index funds. You don't really spend much in terms of fees. They are low-cost vehicles. You don't really charge you so much compared to other classes of assets. And in investing, you should not forget the fact that the lower your fee over time, the higher your returns. And if the fee you are paying, is relatively much, it will eat into your return at the end of the day. And to be very, very conscious of the level of fee you are paying. That's why I will advise that you key into assets asset classes that will not attract so much fees. Then lastly, number 10, seek professional advice. Although investing might be a personal affair, it might be a personal journey, but by the time you incorporate the service of a financial advisor, then of course the individual concerned would help you to be able to ascertain your risk tolerance, your level, your time horizon, and be able to design a kind of portfolio that will help you obtain something tangible at the end of the day. And so engage the service of a financial advisor. They will go a long way in helping you, because these are smart, professionals, intelligent people in their field. They will make a positive impact in the kind of returns you are going to get. So don't shy away from that side. They may charge a level of a kind of they may charge you some amount of money as fees. Don't allow it to discourage you. At the end of the day, you discover that it is worth it. You cannot do without the counsel of a financial advisor.